Hey everybody, what is going on? Welcome into our latest Trade to Black podcast. I'm your host, Shad Deals. Thanks for checking in. Today's interview, we're actually speaking to a company that's invested over $1.6 billion in the overall industry. And for a lot of MSOs, they're really the backbone. So we want to get an idea as to how the whole investment world within this space is going to look moving forward in 2025, because then there's a lot of questions that a lot of you have out there right now. So to get a better idea, let's first welcome in Mr. Anthony Varrell. Good to see you, sir. And you were the man to set this all up. So good for you. And this should be interesting.
Yeah, I'm interested to jump into this conversation. Obviously, the way the capital is allocated and deployed in the cannabis industry has changed over time. Chicago Atlantic's been in the industry for some time now. Like you had said, they've got 1.6 billion that's been deployed into the space. So yeah, I'm happy to get Peter on and talk to one of the more institutionally driven firms that are related to the space when we talk about the cannabis conversation.
Yeah, and in due time, you want to know how much does that 1.6 billion grow in the event that we start to see some change in this overall industry. So with that, let's welcome in the managing partner of Chicago Atlantic, which trades on the NASDAQ under the ticker symbol REFI. Peter Sack, good to meet you. How are you, sir?
Great to meet you too. Thanks for having me on. Doing well.
Good. I shouldn't say good to meet you because I know you've been on a few times, but we could, forget it. I'm just going to be honest with you. Post-production, we don't need to edit that out. I'll just make my mistake on air. But how are things overall? Good?
Yeah, life is good. Life is good. It's 2024 year was a year of positives and a fair amount of negatives, but we continue to deploy, continue to raise capital, and continue to support folks growing in the industry.
Yeah, and I think a lot of people want to understand that more. Like I said off the top, 1.6 billion, that's a big number to say the least. And I think a lot of people want to get about understanding is how are you deploying capital moving forward as this industry, as we know, there's a lot of question marks that pertain to it. However, in the event that if everything comes to like fruition, like we hope it does create a big opportunity. So maybe talk a little bit in depth when I talk about this 1.6 billion and what you've invested in for the investors that aren't familiar with exactly what you do and how you deploy. Maybe outline what exactly you guys specialize in.
Yeah. So we focus on providing debt capital to cannabis operators in generally limited license states to support growth, whether that's building dispensaries, building cultivations, executing acquisitions. We work with a number of the large public MSOs, but our bread and butter and where we spend most of our time is generally with private operators that are single state operators or one or two state operators looking to grow and looking to build on their track record of success in their core markets to expand into adjacent markets, whether that's in the same state or in neighboring states. And we invest through three vehicles primarily. We operate a publicly traded mortgage REIT under the ticker REFI. We operate a public BDC under the ticker LIEN, LIEN, and we operate private funds. And so from these sources, we're investing both cash flow loans and real estate backed loans that really allows us to invest across the whole spectrum of companies.
Yeah, Peter, as it relates to the way that you're deploying capital, I mean, we've seen some headlines here in the last couple of weeks to months regarding sale-leasebacks. You're a mortgage REIT under the REFI ticker. Can you explain just on an elementary level how the nature of what you're doing differs from the leaseback model in terms of capital deployment?
Sure. So a sale-leaseback is when a company sells its property to an investor in exchange for a large amount of capital and then leases that property back from the investor. And these are often done through equity REITs, of which IIPR is a good example.
Yeah.
Our model is a bit different. Rather than acquire the property from the operator, we allow the operator to continue to own the business, own the building, own the real estate, and we provide a loan that's secured by that property. And we find that this allows the operator to have more flexibility, allows the operator to continue to own what is its strongest asset and most valuable asset, generally cultivation and retail properties. And our loans are shorter duration. So our loans are 2 to 4 years. Whereas when you execute a sale-leaseback, that's generally a 5 to potentially indefinite commitment to lease that property from your new investor. Our model is a bit different. Our mortgage REFI is a bit different from most mortgage REITs in that in addition to lending against the property, we're also lending against all assets of the business. And so we're focused not only on the value of the property, but we're also focused on cash flow generation, ability to service indebtedness, resiliency of the business, and their growth prospects.
Has that robust underwriting process and the way that you are deploying the strategy, is that what ultimately has led for, let's say, that 17% annualized gain that you've had throughout the life cycle of the mortgage REIT?
Absolutely. So the returns have varied across each of the vehicles, but our track record, and specifically really limited track record of losses, is driven by that fundamental holistic underwriting process where we're focused on cash flow generation, ability to service indebtedness, and hard collateral. And really that's based fundamentally in an understanding of each of these markets, that before we make a single investment, we're underwriting the market and the piece of the supply chain and the competitiveness of that market over the following 5 to 10 years.
So walk me through today, when you're speaking to a lot of MSOs, what would you say are the top 2 or 3 main objectives as to like their needs, as to what they, let's face it, it's tough to obviously raise any money in these current market conditions, but what are they coming to you for? And what are the biggest concerns or questions that they have that you are ultimately, I guess, the solution?
They're looking to finance either to refinance existing indebtedness, of which there's a large overhang in the industry,
Yeah.
But more optimistically looking to finance growth and looking to fund that next state, that next batch of dispensaries, that expansion of cultivation. We're spending a lot of time with operators, whether that's MSOs or single state operators or new entrants in places like Ohio, Missouri, Maryland, and New York.
Talking about the duration on some of these loans, has that duration allowed you to insulate yourself from, let's say, the boom bust? I don't want to call it boom bust. I guess that's strong, but the pricing curve that we've seen as markets mature. For instance, Ohio, just anecdotally, we're starting to see price compression very early in that cycle. Is that part of the thesis behind these shorter duration timelines on these loans versus, let's say, the long-tailed loans with the sale-leaseback model?
Yeah, absolutely. I'd say there's three key levers to controlling risk. We try to underwrite and structure each loan such that at its maturity, the company is less levered and less risky than it was at the outset. And we do that really with 3 levers. That's A, relatively short maturities of 2 to 4 years.
Yeah.
B, it's financing growth so that our capital is going towards growing earnings. And C, it's through amortization. The majority of our loans carry amortization of 10 to 12% per year. And so that means that cash is going to de-risking the business over the period of our loan. And having these short durations, it really allows us to reevaluate each market on an ongoing basis and reevaluate each of the leverage points. And when our loans come close to maturity, our borrowers are coming back to us and saying, Peter, we know we're coming to maturity. We need to address our existing debt, and we also have all these growth initiatives that we want to continue building on.
Yeah.
And so we're talking about refinancing. We're talking about adding new capital. We're talking about supporting their next stage of growth. And we're usually competing again, and hopefully we can compete to win. And we've proven ourselves a valuable partner over the life of that loan.
Yeah. So our audience is going to want to know, like, what would you say, I guess, are the biggest opportunities in terms of like funding opportunities? You outlined Ohio, you've outlined Maryland, even New York, which is great to see how that's starting to turn around a little bit. But is it more on the private side? Is the public side? Like, what are you seeing as far as in terms, like I said, of funding opportunities, where the biggest, I guess, opportunities present themselves here in 2025?
Yeah, we spend at least 2/3 of our time with private companies.
Okay.
And these are small loans of 10 to 30 million, not 100 to 300 million. And I think this is both where we differentiate ourselves and where we learn the most about these markets, is by speaking to people on the ground, being in cultivation facilities, walking dispensaries, learning what's selling and what's not selling. It's also a key piece of our platform that we invest in people and resources to be on the ground in the states that we're focusing on, and meeting the best operators when they are generating $10 and $20 million of revenue, rather than just spending time with them when they're generating 50 to 100 million of revenue.
We talk about the United States a lot, obviously, within our platform, as that's really our core focus. There's still a large part of the conversation, with the exception of Curaleaf, has been international growth. Are the international markets something that you're looking at, or something that you're looking to deploy into, let's say, in the coming years, or is the addressable market in the United States still so dense that the opportunity is here and ripe for the taking as it relates to deals that can get done in the United States?
We're certainly supporting U.S. operators and some of our existing relationships that are looking to expand internationally.
Yeah.
But our focus is really on the U.S. We think the opportunity here is still the most attractive in the world, and that's where we're focusing our resources and our relationships. And I think in all of these cases, we're cautious of focus, and we want to be focused on providing the best experience and the best relationship both to our borrowers and to our investors.
Yeah.
And we can do that by being focused here in the U.S. And we have 40 different markets in the U.S. to understand on an in-depth basis. Don't necessarily need to add another 40 around the world.
Yeah. And then in 2024, I mean, I like to think it's 2024 as a positive year for the industry. I mean, we got the rescheduling gears in motion. There was a lot of conversation around the cannabis industry. However, the capital markets activity was volatile at most. How is your pipeline looking in terms of origination and new opportunities? Are you still seeing that robust need for capital within the private markets, despite what the public markets would telegraph to some?
Yeah, I mean, the need is there. The need is in the public markets too. It's just the access to capital and the barriers getting it are so high. We've been hamstrung over the last year by a couple things. I think one, and I think the overarching theme is uncertainty.
Right.
Yeah.
And there was uncertainty about Florida, and I think even whether Florida passed or didn't pass, there's some benefit to the fact that at least we know now, and so people can make decisions based on that certainty. That the referendum did not pass. 280E is another still piece of uncertainty that hangs over us today, and rescheduling. And so I think we're going to see a lot more opening up and activity of capital markets when that becomes clear and becomes more certain, and when treatment of existing tax liabilities is going to becomes more certain.
Yeah.
And all of this flows through to valuations, and with really deteriorating public valuations, leads people to opt to do nothing rather than execute a large M&A, use their stock as currency. And it takes time, I think, for expectations around valuations to reset.
Yeah,
so
I think we're looking at that right now with the reset in valuations. I'm hoping we're almost at that bottom.
Yeah, you were basically in so many words, you were walking before you ran, because there was still uncertainty around Florida. As you said, we know where we stand now. So how are you approaching this market? Because there's still adult use. Anthony, you mentioned a few times that, this is probably getting pushed out for another 2 years. We're seeing a lot of change. People are obviously trying to pivot in real time based on what's happened in the last 3 months. But how are you positioning and how are you preparing yourself for that market? Or is it even something that there other opportunities elsewhere that you have more, I guess, concentration on?
Yeah, so we deployed tens of millions of dollars over the last 6 years in Florida as a medical market. And we underwrote a medical market. We underwrote our clients' ability to operate in that environment. And so we're doing the same. So we're continuing to support existing operators to increase their footprint, increase their dispensary concentration. I think we're going to see competition heat up. We probably will see some margin compression, but it's still a very attractive environment, a really attractive market.
So regardless what happened 3 months ago, you're still seeing a lot of interest, and like you said, competition has only increased since then. Obviously it would.
Yeah, competition increased, but the positive about Florida is that you can build a lot. If you're an existing operator, you can continue to expand your retail footprint in a relatively cost-efficient way.
Yeah.
And if you are disciplined about your cost of build out, your cost of expansion, there's still path to growth in an accretive manner. Is it not nearly as attractive as if the referendum had passed? But I think the focus now is on profitability, discipline, and really smart choices.
And then we also talk about banking reform a lot on this program. I think that there's a preconceived notion out there that banking reform would be a net negative for the financiers of the industry, for the financial services firms of the industry. I happen to believe that it would be a huge net positive versus what, let's say, some in the retail community would suggest. How would banking reform fundamentally alter and strengthen ultimately the business at REFI?
Yeah, it's really about reducing friction across the whole industry. It'll reduce friction for our operators, give greater flexibility to our operators, lower equity cost of capital additionally for our operators significantly, which gives them more equity capital, more cash flow to deploy to build new projects. That ultimately means more opportunity for us to deploy.
Right.
From our capital base, it'll decrease our cost of capital significantly as well. We get loans to support the growth of our loan portfolio, both across all of our vehicles. And that will increase our cost of capital, decrease our cost of capital significantly, and allow us to continue to compete. Our moat is expertise. Our moat is relationships. And safe banking is an initiative that we're strong supporters of, and it can't come fast enough.
Yeah. That's I think we're all in the same agreement there. And then as far as that goes, taking it a step further, what does the current access to, let's say, investors look like for your vehicles? Let's say with financial professionals, registered investment advisors, is there access right now to that group of capital allocators? And would that pool deepen tremendously if there is banking reform and further regulations on the industry?
Absolutely. Our public funds, REFI and Lean, carry an institutional investor base as well as a retail investor base that we get access to because of our listings on the NASDAQ. Our private funds are made up primarily by RIAs, high net worth, and a limited amount of pension and institutional investors. And every step in opening up capital markets to cannabis means greater access to capital for us, which ultimately means greater access to capital of our clients.
Well, it can't be underestimated. When you said NASDAQ, that obviously has everybody's attention. When we look at this industry, there's a lot of retail investors that get fixated on one stock, and they will live and die based on that one stock. But to Anthony's point, when we look at some sort of banking reform, if you're in front of a group of investors and you look at your overall business model and there is reform, further to that, and what you just said, being on a NASDAQ listing, why, like, what I don't want to say what interests you, but where do you see the value of a stock like yourselves, though, providing investment advice, where you look at your model right now being listed on a senior exchange, and why, I guess, people within the actual company are optimistic about the overall future of the industry?
Yeah, to be honest, we don't spend a lot of time forecasting these large regulatory changes.
Yeah, of course.
We underwrite and raise capital assuming that there are very little improvements in the regulatory outlook, particularly at the federal level. That means that we're focused on creating vehicles that generate attractive, differentiated dividend yields and income with significant downside protection. Now, that means that our stock is often less sexy, but it's also a lot less volatile.
Yeah.
I think one of the days that I'm most proud of in the performance of our vehicles was Election Day, when the Florida referendum failed to pass and MSOS dropped by nearly 30%. And we were flat to maybe down 1%.
Well said.
I think that's a great point, and that the asset class of the REITs and dividend paying stocks do buck the trend of volatility. And they absolutely show relative strength in terms of downside. I don't want to call it downside protection, but definitely the downside volatility that we see in the MSOs as well as the underlying ETF. And then for 2025, I mean, a lot of people are excited about 2025. A lot of people are skeptical about 2025. How are you looking at 2025 thematically from an industry perspective? And where do you think that we sit, let's say, come December of this year?
I think 2025 should be a year of operator focus on execution.
Yes.
Disciplined execution on focused growth and cost controls, and focus on core markets. And if you pursue that path, upside that comes through federal reforms will be wonderful, and regardless. And so that's what we tend to be focused on in our underwriting is helping our borrowers execute those key initiatives that are going to drive performance over the next 2 years, regardless of what comes in DC.
Yeah, well, we're already starting to see that already here in the early stages. But it's the moment of truth for obviously the industry. But You make a very good point. You know, when a lot of the MSOs were down 30% over after the election night, very good point, especially when we're in an industry where there's volatility and extreme volatility, and still a lot of question marks because, you know, in a lot of ways, this industry still is very dependent on what happens in Washington. But to your point, from a business fundamental, it's all on execution. So these are the days where you got to put everything to work. And when the opportunity presents itself, you got to be ready. But with that, listen, appreciate you checking in here today, and look forward to like talking more about industry trends and then what we can expect as far as investment opportunities for the overall space moving forward. But thanks for checking in here today.
Likewise. Thanks for having me.
All right. Thanks, Peter. Hey, everyone. Thanks for watching our latest podcast. What'd you all think? Is there any information that we're missing? Is there anything you want us to cover? As these industries heat up, we're getting access to more and more big hosts. So let us know the questions that you want us to ask for you. As usual, smash that like button. We want this to go viral. Click on that bell for all notifications for the latest interviews that we're doing. And as usual, let's build this community. Subscribe to our channel because we appreciate it, because we wouldn't be here without you. Thanks for watching, everyone.